Mark Yusko has been perfecting the university endowment model of investing to help clients achieve goals in the alternative space prior to founding Morgan Creek in 2004 and growing it to $8.5 billion in assets under management. Mr. Yusko was CIO and founder of UNC Management Co., University of North Carolina. And before that, he was a senior investment director at the University of Notre Dame. In this keynote, he's going to give his views on the marketplace from the perspective of a long-time investor in alternatives. So without further ado, please help me welcome Mark Yusko.
All right, good morning. And looks like you guys did have a good night last night. So for those of you that got up early to come, I'm going to dive in real quickly because I, as usual, have way too many slides. So to make up for it, I'm going to talk really, really fast. So what it talks about today is welcome to the new abnormal. People talk about the new normal. I think it's actually pretty abnormal, and why private investments will be critical as we go through the next few years. So start the presentation with a couple quotes. One, that a plan conceived in moderation must fail when circumstances are set in extremes. Doesn't say might fail, doesn't say must do a little bit badly, it says must fail. Now the second quote, we always overestimate the change that will occur in the next couple of years and underestimate the change that will occur in the next 10. So I can give you a couple examples of that. So my wife and I had a plan for 19 years. And 19 years is important because most investors today had a plan for 19 years. From 1980 to 1999, all you had to do is buy US equities. But since 1999, that plan broke down. So my wife and I had a plan for 19 years on what we're going to do with all of our free time. But that was before our newest arrived. So we have a 22-year-old who just graduated from college, a 19-year-old, a sophomore in college, and we have the first member of the class of 33. So our plan is kind of blown up. He's watching his sister do hip-hop there. But if you look at the last 10 years, U.S. equities have delivered the princely sum of 0. Now, there's a technical term for that. That sucks. And if you've kept all your money in U.S. equities, which most people do, most people have the bulk of their capital in U.S. equities. And I always ask them why. Why do you have so much money in U.S. equities? Most people have the bulk of their 401k plan. Most universities and endowments and pension funds have most of their money in U.S. equities. Yet for 10 years, you made no money. Even if you gave money to the world's greatest investor, quote unquote, he made you 4.5% a year. Warren Buffett made 4.5%, not 45% or 14.5%, 4.5% for the last decade. A monkey throwing darts in emerging markets made you 3.5 times your money. I'm sorry, yeah, 3.5 times your money. A monkey with a little aim made you 4 times your money. And a really good monkey made you almost as much as gold. Now, gold has made you almost 7 times your money. People say, Mark, gold's not an investment. Gold's for crazy people. Real investors don't own gold. We own stocks. We know that stocks outperform gold. Well, not for the last 10 years, or for the last 20, or for the last 30, or for the last 40. So since we went off the gold standard, 1971, gold's outperformed stocks. And it's going to outperform stocks for the next 10 years. I'll explain why in a little bit. But there's no way that we can say that stocks outperform gold when the data says it's not true. Now, if you look over the last 10 years, okay, stocks have given you the same return as cash. So the efficient frontier hasn't worked very well. Now, you could modify that frontier by adding private investments and emerging markets. And the top quartile endowments, the biggest endowments in the country, earned 8 to 10% over the last decade instead of nothing. 8 to 10 is better than nothing. In fact, it's a lot better than nothing. So how did they approach investing? Well, they took a very different tact. So before we talk about that tact, let's talk about how we got here. Why are we here? Well, for 6 decades, we levered up. Now see, what happened is, back in 1929, you can see there was a big levering. What happened is, in the 20s, they had a big party. It's called the Roaring 20s. And in 1925, everybody lost a bunch of money in the real estate. And then they took what little money they had left and they put it in the stock market. At the peak in 29, 4 out of every $5 lent by American banks was invested in stocks. It was just a big old Ponzi scheme. So it collapsed, went down 86%. And a whole generation of people said, I'll never own a stock and I'll never borrow money. But then we came along, the baby boomers, and we said, debt, love it. First mortgage, love it. Second must be twice as good. In fact, I want those third mortgages. I want that new Porsche out there. It's a beautiful car. I can't afford that. Oh, I can lease it. I'll take 2. Wave them in. Okay? Big screen TV, $5 grand. Can't afford that. Oh, no payments? 1 for every room. Flat screen TV in every room. So we levered up like crazy people until when? From 1980 to 1999, we levered up like crazy people. And then what happened? The market collapsed. It went down 45%. We lost a bunch of money. And what did we do? We took a little money we had left and put it where? Real estate. Everybody got into real estate. A friend of mine is a venture capitalist in Boston. He owns 17 condos down in Miami. 17. He had a sale about 4 or 5 months ago, half off. No lookers. Not no offers, no buyers. No lookers at 50% off. We have one of our portfolio managers that is out buying condos in Miami. He bids 25 cents. He has a little sign that says, I'll buy your condo for 25 cents. He hasn't bought any yet because the price has come down to about 40. And we're going to buy them all, even the Trump ones, because everyone in Miami is going to sell over the next 10 years as people retire, start to move down to Florida. So the key is that we've levered up like crazy people. Now, what we're taught in school, it's my 25th anniversary of going to Chicago Business School, now the Booth School. So what they taught me was bonds suck on the left, no return, no risk, high yield's better, and equities rock. If you take risk, you get paid. Problem is, over the last decade, that didn't work. Bonds sucked, they didn't do anything very good. High yield was better, but equities lost you money for 10 years. How can that be? Well, see, stocks in the US, Japan, and Europe, what I call the submerging markets, are no longer stocks. They become options. Because what happens, I only took one accounting class, undergrad. I was a biology and chemistry major at Notre Dame. Took one class, my dad made me take accounting. I took it over at St. Mary's College. It was me and 31 girls. I don't remember a lot of accounting, I remember a lot of numbers. I do remember one accounting identity. Assets equals liabilities plus owner's equity. When your liabilities exceed your assets, you have no equity. Japan, as a country, has no equity. Europe, as a country, has no equity, or continent, whatever you want to call it. United States, as a country, has no equity. Our liabilities exceed our assets. So what happened is equities went down. Now what happens when they turn into options? What do options do? Well, 85% of them expire worthless. So what happened to GM equity? Went to zero. What happened to Chrysler equity? Went to zero. What happened to Ford equity? Went from 50 to 2. Now when an option doesn't expire worthless, what happens to it? It goes up a lot. So the few things that got saved by government intervention popped up a lot. So if you look at the market, everyone's excited. The market's up 100% in the last 3 years. Big deal. You're still down from when it started going down in 2007. Because people can't do math. You go down 57, you go up 100, you're not back to even. In fact, I was I was discussing with a client a few months ago. He was saying, you guys haven't made any money in the last 2 years. So well, that's odd. We made 9% in 2010. We made 15% in 2009. That's not zero. He said, yeah, but I made 15% in 2010. I made 26% in 2009. I said, yeah, and? He said, what do you mean, and? I said, well, in 2008. Well, yeah, I was down 40 and you were down 24. I said, let's do the math together. Down 24, up 15, up 9, I got 99 cents. Down 40, up 26, up 15, you have 86 cents. 99 is better than 86. And he looks at me with a straight face and says, no, it's not. I said, why not? He said, well, you didn't make the 2008 adjustment. I said, what's the 2008 adjustment? He said, well, I don't count 2008 because that was an anomaly and that'll never happen again. Till today. Today is the start of the next 2008. So it is the 1930s. Everyone wants to say, what period is it? We are in the 1930s. We are in a depression. A depression. Everybody knows what a depression is, right? It's just an economic term. Doesn't mean soup kitchens and bread lines. Oh, by the way, how many people are on food stamps in America today? Anyone know that number? 46.7 million. 1 out of every 6 people in this country eat on food stamps. So that kind of sounds like a soup kitchen or a bread line, but it's quiet. What's the #1 sales day for Walmart every month? It's actually not even a sales day. What's the #1 sales hour for Walmart? From 12:01 midnight to 1 o'clock in the morning on the first day of the month. Because what happens is people run out of money about the 17th, so they don't get food and diapers and stuff for about 2 weeks. Then they go to Walmart and they shop for about 4 hours, fill up 3 or 4 carts at 11:59, and they push through their EBT transfer card, gets recharged at 12 o'clock midnight on the 31st, and they get to buy their food for the next month. So we are in the 1930s. In the 1930s, we had a big party, and we incurred a massive budget deficit, lower left. So we cut interest rates, tried to stimulate growth. Didn't work. We had a lot of debt. No one would buy our debt because we were an emerging market run by the mob, okay, run by a gang. And so we had to do something called quantitative easing. We had to buy our own debt. Now, when you buy your own debt, what interest rate would you like to pay? Zero is good. So we stayed at zero interest rates until 1944. Everyone's wondered, when are they going to raise interest rates? They're not going to raise interest rates, ever, until we go to war. When we go to war, then they can raise interest rates because then you can spend, which gets you out of the problems. Now, I actually predicted in December, down the street, that we'd actually invade Iran in March, and I was wrong. It'll happen before the end of the year. But we will go to war because we have to for a couple different reasons. One, we have to protect the sovereignty of the dollar. That's why we invaded Iraq. It's why we invaded Libya, because they wanted to price oil in euros and gold. Whole other story. But the key is that, look at today. The budget deficit today is way worse than 1929. We cut interest rates to zero to try to stimulate growth. It didn't work. We're not growing in real terms. And no one would buy our debt because we're an emerging market run by a gang. So what do? We buy our own debt. And once you start buying your own debt, you can't raise interest rates. I don't know how Tim Geithner sleeps. He has to refinance $4 trillion. See, I said the T word. No one in this room shuddered. You guys know what a trillion is, right? You guys all, higher education, you can do math. If I lock that door, it's going to be hard because it's a curtain, and I make you sit here with me for the next 31.7 years. That will be unpleasant, by the way. 31.7 years. You got to spend $1 every second. That's $1 billion. You got to spend $1,000 a second. Think about that. $1,000 a second for the next 32 years to spend $1 trillion. We as a government owe 80 of those babies. 80. For Social Security, Medicare, Medicaid, prescription drugs, the biggest fraud committed in our lifetime, $10 trillion liability so my mom can buy a $200 drug for $4. Ask mom who pays the other $196. Don't know. Don't care. So we have this problem. Once deflation starts, once we get into a depression is an economic term. A depression means that you go down, your GDP goes down, and then it recovers, but it never gets back to the previous peak. The U.S., Japan, and Europe together, as the submerging markets, our GDP has not risen above our peak in 2007, so we're in a depression. The emerging markets are not in a depression. But once it starts down, Japan, 1989. If you went to Harvard Business School in 1989, they sent you to Tokyo to learn about Japan Inc. They had the best stock market in the world at 40,000. Interest rates were 8%. By the way, high interest rates are a sign of economic strength. Low interest rates are a sign of economic weakness. You want high interest rates, not low interest rates. Low interest rates are bad. They mean bad things. So they had the best stock market in the world. And then what happened? They were at 50% debt to equity, the light green line. Then the debt started to go up. Then what happened? Their debt got downgraded in 2002 to AA. Oh, wait, that sounds familiar. They hit 100% debt to equity, and they went down to AA. Oh, we went to 100% debt to equity. We went to AA. And their stock market went down, and they tried to rally it using this thing called quantitative easing. And they did quantitative easing 9 times. They triggered 9 rallies in excess of 25%, 3 rallies in excess of 50%, 1 rally in 2006 in excess of 100%. But it's like a rubber ball bouncing down a set of stairs. The end's a bad place. So you can see what happens in the great deflations. They last about 18 years, so we're about halfway through. The market tends to move in a stair-step pattern. Fear, greed, fear, greed, fear. So we're about halfway through this fear stage. And you can see, we know this pattern. In the 20s, from 29 to 44, down and up, down and up, down and up, went nowhere. In 66 to 82, down and up, down and up, down and up, went nowhere. So we went down and up and down and up. Everybody's all excited about this big move in stocks. There's no big move in stocks. You're just recovering the losses that you endured 3 years ago. And by the way, when we have the recession in the 4th quarter, we'll lose it all again. In fact, maybe the market's anticipating it and is realizing that it's going to correct again here. Jeremy Grantham told us this would happen. 2008. This is a slide from 2008. He told us there would be no return on stocks, on the far left, no return on stocks for the next 7 years. So we're about halfway through, and we've had no return on stocks. And he's about 96% accurate when he does these things. So what did the Fed do? The Fed has tried to buoy the markets by pumping liquidity in the markets. And when you pump liquidity in the markets, what happens? It has to go somewhere. It's like air in a balloon. So where's it gone? Into gold. That's why gold prices are up threefold. That's why if you denominate the S&P in gold, you've made no return in the last 3 years. Right? If you denominate the S&P in a real currency instead of the dollar, which is depreciating every day because we keep printing more of them, we've made no return in equity. So they pumped up the price of everything just because of fake liquidity. So if we push a button and make a bunch of money, but real money, in terms of physical gold, which you can't produce enough of, actually has risen in price. So the ECB got into the act with the LTRO. They printed $1 trillion. Actually, $1.3 trillion. Euros, sorry, dollars. I'm converting euros to dollars. $1 trillion. Again, there's that freaking T word. $1 Trillion is ginormous. And does anyone watch the action of the banks in Europe? After the LTRO, what'd they do? Oh, they popped up. Now where are they today? Back down below where they started. Why? Because here's how it works. My little brother wanted to buy a house in 2008. He went to Washington Mutual. They lent him $1 million on his signature. No income verification, important part of the story. Then, because he didn't have money to put down, they lent him that too. And when he asked him, how are you going to lend me $1 million too if I only paid $1 million? They say, oh, we pay our appraisal something, something. They'll appraise it for 1.2. That's fraud, by the way. Then, because he wasn't working, they said, how am I going to make payments? He said, oh, no payments. You don't have to make any payments because we have this thing called gain on sale accounting. You promise to pay us, and we get to write it up as earnings. That's like the old Soviet Union. You pretend to work, we'll pretend to pay you. So the key is that, where did Washington Mutual stock go, by the way? Anyone own some Washington Mutual stock? Oh, it went to zero. It went to zero because you can't lend people money and not get it paid back and actually make any earnings. So then what's Ben Bernanke's solution to my little brother's problem? He wants to lend him $1.3 million to pay off his $1.3 million. So that's what they're doing in Europe. They're paying off the banks they're lending money to the banks to pay off their loans. But then they still owe money. It doesn't really work. The only solution for debt is growth. And how do you get growth? And this is a very sad story. This morning, a man in Greece went to the central square and committed suicide, broad daylight, to protest the austerity. Seems like an awful way to protest, but that's where we are today. How does austerity lead to growth? It doesn't. Okay? How does cutting people's wages in real terms, which we've been doing in the United States for 20 years, make people better off? Now, what's amazing to me is the propaganda machine works so well in America. They surveyed people in America. 54% of them said they're better off than when Obama took office. And this is not a political statement, but there's no way 54% of people in America are better off than they were 4 years or 3 years ago. It's just not possible. Look at every segment of unemployment, real income, debt. There's nothing better. But we have convinced people that all's good. It's all good. It's all good. So look at the debt in the developed world. It's exploded. It's absolutely exploded. And the problem is, if you lever up, you guys are all in the private equity business. What happens when you lever up a company? Its profits are supposed to go up. So if we levered up a country, 1950, we didn't have any debt. And we grew at 4.7% real. Then in the 60s, we levered up a little. And we went up to 5.3. That's the way it's supposed to work. But then, since then, the 70s, 3.7. 80s, 2.8. 90s, 2.5. Today, 1.7. That's the wrong direction. But see, once you get above 100% debt to equity, debt works against you. My little brother has a problem. He owes $1.3 million. The house next door to his just sold for $700,000. He assures me his is much nicer. How much equity does he have? Oh, well, guess what? You guys are all paying his mortgage now, by the way. Because he filed for bankruptcy. He got one of these HARP modifications and cut his principal by $600,000 and got his payment reduced from $4,500 to $1,500. Now, who's picking up that $600,000? All of us as taxpayers, because that's who's subsidizing the HARP program. So that doesn't make any sense to me. He's the dummy that got himself in trouble. Why should I pay for it? Well, it's better for all of you to pay than me. I actually like that better. So here's the problem. If you look at any valuation of U.S. equities, anyone, pick any one on the left-hand side, whether it's the Cressmont PE from his arithmetic mean, the cyclical 10-year PE, the Shiller PE, whether you look at the Q ratio, any measure of valuation, stocks are 40% overvalued. 40, 40, not 14 or 4, 40% overvalued. And we've seen this movie before. Anyone remember last year? January, February, market went up. March, it went down 1%. April, it went up a little bit. And then what happened the rest of the year? Oh, it went down a lot. It went down 20%, and then it rallied in October, and we finished flat for the year. Average stock was flat, S&P was up, everything else was down. But if you look this year, we went up in January and February. March was a little more choppy. Now, this thing on the top is called a Bradley cycle date predictor. So what it says is that there are these certain dates that, for whatever reason, markets tend to change trend. March 16th was the trend. We peaked intraday on March 16th. And we will go down the rest of the year because we have this problem. There is no growth. There's no GDP growth. Profits are falling, not rising. There's going to be more negative earnings surprises this quarter than last. So we have this problem that we can't just keep levitating by stimulus. And he said yesterday that he can't put any more stimulus in because he's run out of bullets. So if you look at what the S&P should top out at, it's about 2 or 3% away from here. The one on the right really scares me, VIX. If you look at the term structure of volatility out 6 months, it says volatility is going to explode by 60% from here. It's going to go from 18 to 24. That will be bad for equities, very bad. High-yield bonds. Last year, high-yield bonds started to go down first, and then equities followed. This year, high-yield bonds started to go down, telling us that equities are going to fall. The economic surprises, when they start to roll over, and we've missed 13 out of the last 14 economic numbers have been negative. The one on Friday will be really negative, the NFP. Okay? So we're going to be 14 for 15 misses. When those start to roll down, markets go down. And the biggest problem of all, you know why we've had any earnings at all in the S&P in the last 3 years? Because we have a budget deficit of $1.6 trillion. If we went to a balanced budget, which there are certain Republicans that want us to go to a balanced budget, if we went to a balanced budget, what would happen to S&P earnings? They would fall in half. Because most of the people buying Apple products are doing it with direct transfer payments from the government. So when you take that fiscal cliff on January 1st of 2013, because the idiots in the super committee couldn't agree on anything, $500 billion of spending cuts occur. There's no way to reverse that. They occur on January 1st. The market's going to figure that out pretty soon. And then the Bush tax cuts expire on 12/31 this year. And they're not going to get reinstated. No matter who controls the House, the Republicans are going to get the House and they're going to reinstate them. Really? And they're going to keep with a $1 trillion budget deficit in an election year? I don't think so. I don't think you get elected telling people that you're going to spend an extra $1 trillion of their tax money. So the Eurobank stepped in to try to save the rest of Europe from becoming Greece. You can see what happened to Greece back a year ago, March. Their yields started to explode. So the ECB came in and expanded their balance sheet by $1 trillion. Now, the problem is, on the left-hand side, what you see is what happens, that red period from 2010 and 11, you can see what happened to Greek bond yields. The red is expanded on the bottom. That's their stock market. Their stock market went down 95% when their yields exploded. You can see Italian and Spanish bond yields have made this nice basing pattern and are about to lose control. So the ECB got them back under control last fall, but this morning, Spain ratcheted up another 24 basis points, is starting to get back close to that 6% level. And once it gets back to 7, they will lose control. Those stock markets will collapse. Because what the bond market's telling you is the equity value is 0 because there's too much debt. You guys, come on, you can do buyouts. If you put too many turns of leverage on a company and the revenues fall, what happens to your equity? It goes away. So in Japan, we have a different cycle. They've been going down for 19 years. And now, with a combination of momentum, a commitment to reflation, we think Japan, you can see the yen finally ticked back up from 76 to 83. We think the yen could hit 120, 130. Japanese stock market could rock for the next decade. So opportunities, what do you do in the new abnormal? Well, demographics, emerging market consumption, and resources. Demographics are destiny. I tried like hell not to turn 48 last year. I did anyway. And I'm going to turn 49 next month. Okay? You just get old. Demographics don't stop. And once you hit 65, Japan hit 65 in 1989. As a country, they started to turn 65 in force in 1989. And what happened? Their stock market went down. It's not a really big scientific study. When you're 40 to 60, you buy a lot of shit. When you're 65 to 85, you save a lot of money. Because, oh, the Japanese are thrifty, they're savers. Are you joking? In the 70s, what did they save? 0. They had negative savings. They bought everything. Pebble Beach, every building in New York was owned by the Japanese. Okay? Then they turn into savers because they get old. That's what's happening to us. Why is all the money coming out of stocks and into bonds? Because we're becoming savers. And when your peak spending years, 45 to 49, which is when you have maximum spending, your maximum spending is age 46 and a half. That's when your maximum, you got both kids in college, you got the big fancy cars, you got the big mortgage, that's the maximum spending. When that starts to decline, that's bad for economies and for stock markets. So if you're going to own equity, wouldn't you want to be where there's growth? Well, where's all the growth in the world? They asked Willie Sutton long ago, Willie, why do you rob banks? That's where you keep the money. So if you're going to own equity, own where the growth. Oh, where's all the growth? South America, Africa, Middle East, and India. The 5 fastest growing countries in the world today are in Africa. Over the next 80 years, think about this, over the next 80 years, United States population is going to grow marginally. Europe population is actually going to shrink. Chinese population is going to shrink by 1/3. Think about that for a second. Just let that wash over you. 1 out of 3 Chinese people disappear because they have the one-child policy. So they have this massive demographic problem. Africa is going to grow by 2.5 billion people. I was in South Africa about a month and a half ago. I was talking with a guy from Nigeria. Nigeria has 150 million people in it today. By 2050, it'll have 450 million. I sat with the guy from Walmart, who they just bought Massmart. They have 3 stores in Nigeria. 3, with 150 million people. I have 3 Walmarts within 10 miles of my house in Chapel Hill. They're going to build a lot of Walmarts. And what was the best performing stock in the 1980s, by the way? Oh, it was Walmart. So what's interesting is massive, massive growth in places like Africa. Massive, massive degradation in the submerging markets, the US, Europe, and Japan. Japan this year will sell more adult diapers than baby diapers. More adult diapers than baby diapers. So welcome to the BRIC century. Brazil, Russia, India, China. US falls to number 3. Look where Germany goes. Germany falls off a cliff because their fertility rates are down. Italy, Spain, all those countries. Italy has a 1.3 birth rate. You need 2.1 to replace yourself. And the problem is they're not doing it, and they're all going to start declining very, very rapidly. On the left-hand side, Saudi Arabia, Egypt. You know what the birth rate in Saudi Arabia is? 9. 9. They're building a little army. Indonesia. How many people in Indonesia? Anyone know how many people are in Indonesia? There's 220 million people in Indonesia. It's just an archipelago of islands. Now, here's the interesting thing. Everybody worries about Greece. Everybody's talking about Greece. Greece doesn't freaking matter. Greece is a bunch of rocks. There's nobody who lives in Greece. We just go there and lay in the sun and then come home and hope the caldera doesn't blow when we're there. So there's nothing there. It doesn't really matter. Ireland doesn't matter. There are more people in America born in Ireland than there are in Ireland. Not second, third generation. First generation Irish, more in America than there are in Ireland. Only 4.5 million people in Ireland. There are 80 million people in Colombia. 80. There's 220 million people in Indonesia. There's huge growth in all these countries. And the biggest problem is they don't have the same belief system that we do. So there's all kinds of issues. But the consumption boom is the killer app. There's going to be more consumption in the emerging markets than in developed markets. So you look at the developed markets line, look at the US consumption line on the right-hand side, lower right. It's going down a lot because people don't buy as much stuff when they get older. There have been 3 great ways to make money in emerging markets. The first was to buy the exports. People sold us cheap DVD players. The second was to buy the people that owned all the commodities. The next wave is to buy all the consumptive properties, the budget airlines, the second home developers. All the things that we did over the last 40 years are going to be repeated in emerging markets. This is really interesting. For the first time ever, you're seeing China spend more on education and research than we do in America. So historically, we have been the center of all innovation, and they just copied. There's a company called Huawei, and they stole some technology from Cisco, and now they kick Cisco's ass because they have better technology for cheaper, because they reverse engineer. Now, they don't have to reverse engineer anymore because there are more PhDs in engineering in India and China than we graduate engineers. My son wanted to go to Stanford. I'm glad he went to Notre Dame. I wanted to go to Notre Dame, but he wanted to go to Stanford 2 years ago. He applied. He made it from 34,000 down to 4,000, got an interview, and then he got dinged at the end. Why? Because they took 51% people at Stanford, international and minority. So the top 20,000 people at IIT get into IIT. That's out of 2 million applicants. The next 20,000 go to Stanford, Harvard, MIT. And guess what happens? After they graduate, here's a great story. There was a kid, graduated top school in China, came to Durham, got a PhD in physics. Morgan Stanley here in New York hired him for 2 years. And what did the US government just do? Shipped him back to China. He gets a free education, fully paid for, with a stipend, gets 2 years of training at one of the best firms, well, arguably one of the best firms, which depends which side of the house you're on, but with a great firm, and now we're shipping him back to China because his HB1 visa's out, because we're stupid. In the class of 74 at IIT, there were 1,500 graduates. 900 of them live in America. 450 of them are business owners. They've created over 250,000 jobs. They don't take our jobs, they create our jobs. 1 out of every 2 companies in Silicon Valley is founded by an immigrant. Why are we educating and sending them home? So they can go work for the companies founded by these guys. So as people industrialize, what do? They buy more stuff. What's stuff made out of? Oil. So China used the same amount of oil we did in 1904. They're going to use more oil. There are going to be more cars and trucks put on the road in the next 30 years in China than all the cars and trucks manufactured in the history of the United States. You sell a lot of cars and trucks. And that's good for platinum and palladium and oil and other stuff. So the problem with oil, God played like a cruel joke on us. He put all the oil underneath the most volatile region in the world. Okay? Places like Iraq and Iran and Afghanistan. So they have all this crazy stuff, you know, where we have this problem. If Iran gets pissed off, if we do something to piss them off and they close the Strait of Hormuz, oil won't go to $150. It'll actually go up $150 overnight. So if we attack them, or if Israel attacks them, it will be very, very ugly. And you think $5 gas? I was in Chicago the other day, $5 gas. $1 taxes, $4 elsewhere. But wait till it gets to 10. Wait till it gets to 12. Then it'll be painful. So gold. Everyone wants to know where gold's going. For 4,000 years, it's a pretty long trend. For 4,000 years, 1 ounce of gold bought a fine man's suit. Fine man's suit today arguably costs about $2,000. That's where it's headed. There are people who say it's going to $3,000, $3,500. I can actually make that argument. All you got to do is watch the debt ceiling. When we raise the debt ceiling in October, gold will spike again. Because it's just, see, currencies don't appreciate. Currencies can only depreciate. If I have $1 million and I print another million, the value of my currency just fell in half. But everything else that didn't print, gold, stayed higher. So it relatively looks like it appreciates, but it actually just doesn't depreciate. It's the difference. So defense wins championships, but we can score. So how do we score? If we do nothing, if we stay in cash, which most people have too much cash, you don't make any return. See, you have to choose. Do I want to own risk assets or skill-based assets? Do I want to own liquid, skill-based, or illiquid? I'm going to argue I want to own illiquid. Why? Because in a low-return world, only 6 things you can do. Anyone here named George Soros? Never comes to my speeches. Okay, so don't be a market timer, because he's the only one that knows how to market time. You can be an active trader. Anyone here trade 26 times a millisecond? No, so don't compete with high-frequency guys. You can go to cash, but you have no real return. You can go illiquid. You reduce flexibility, but we like illiquid. You can leverage, if you could get it, which you can't get much today. And you can innovate. But the problem with innovation is you have maverick risk. So if you do nothing, I have a shirt, front, Chinese symbols on the back. No risk, no reward. I'm sure the Chinese symbol says, this jerk bought this shirt. If you take no risk, you make no return. You stay in cash, you make no return. You got to choose which risk. Do I take credit risk? Risk of default. Don't get my money back. It's a contractual claim. I can sue. Okay? But I only get paid 2% above risk-free for that. Then I can take an equity risk. I can take a contingent claim. I get paid 5% more for that. Or I can take illiquidity risk, private equity, private real estate, private energy, private debt. It's another 5%. Long-term, 4, 6, 11, 16% for private equity, long-term returns, net to investors. Way better than stocks and bonds. So why doesn't everybody have more in private equity? Don't understand. Today, going forward, cash is 0. Bonds are 2. Equities at best are 4 or 5 in the U.S. In emerging markets, 3% risk-free, another 3% for yield, emerging market bonds at 6. You get 10 for stocks probably, but illiquidity premium today is double its long-term average because nobody wants to be illiquid. So I say, if you have 5% in private, double it to 10. If you have 10, double it to 20. If you have 20, double it to 40. If you got 40, double it to 80. Whatever your tolerance is for illiquidity, double it, because that's where all the returns are going to come from. In emerging markets, you're going to make twice as much going forward. We'll skip over that. Jeremy Grantham agrees. He says that you're going to make no return in stocks over the next decade. You're going to make negative returns in bonds. It's going to be a tough place to be. But there are some places, emerging markets, international, and some high-quality, unlevered companies in the U.S. that might make some money, and commodities. Our view on private, much more robust. We're doing growth capital investing in Asia, okay? Buying companies growing 30, 40% at 5 and 6 times EBITDA. It's tough to lose money doing that. In fact, we make about 25%, and that's on a bad day. We can make 30 or 40%. We're doing real estate in South America, making 20%, and that's on a bad, that's on a bad day. If we do a really good deal, like one we just did recently, we might make 30 or 40%. But these are private investments. We're going to have to lock them up for a while. Maybe we're going to have to lock the second one up for 5 or 6 years, but that's okay because we're going to make better returns. When no one else wants private investments, that's when you want to buy. So when no one else wants to put money in venture capital, that's what you should be doing. The fact that nobody wants to do venture capital today, it's the best time to do venture capital. Co-investing. If you can co-invest and cut fees, we cut about 70% off the normal fees by co-investing on big deals that our LPs, our GPs do. They let us come in, and we've had very good experience of that. We love co-investing. We think it's a really great way not only to lever down the fees, but to shorten your time horizon, boost your IRR. So this is a portfolio that we put together around the world. You have to own things on a global basis, and you want to own things that make sense, like the largest meat producer in China. I'm not sure of a lot. My wife says I'm frequently wrong, never in doubt, but I'm not sure of a lot. I am sure that the Chinese are going to eat more pork. I'm 100% certain of that. So owning the largest pork producer in China is probably going to make us a lot of money. In fact, we think we'll make 10 times our money on that. And you can see gold mines in Argentina. We just sold that actually. That shipping, that oil storage facility just got sold for 3 times what we paid for it. Copper mines in Papua New Guinea. How much copper is there in a new car? 550 pounds. Copper is a really important thing. When you wire up a new house, use a lot of copper. Wire up a new building, use a lot of copper. Everything up there, from commercial banking in Rwanda to gold mines in Australia, incredible opportunities to make money around the world. So today, your problem is cash is 0, bonds are 2, stocks are 5, at best. If you stay in a 60-40, you're screwed. You're going to spend 5 or 6 or 7, you're going to make 4, you're going to get less rich. You can boost the efficient frontier by adding emerging markets, but you have to add the private investments, the real estate, the energy, the commodities to get where you need to go. Thank you very much.